ICAI students, let's revise CA Final AFM, Chapter 6 Portfolio Management, Practical Question 10. Given below is information of market rates of returns and data from two companies A and B. So for 3 years they have given market return, company A's return and company B's return. You are required to determine the beta coefficients of the shares of company A and B. Here they are asking the beta coefficients. We should not confuse it with the correlation coefficient, because correlation coefficient is nothing but the linear relationship of a stocks between two stocks. Let's say in this case, if they are asking us correlation coefficient, then it will be between company A and company B. But beta coefficient is the sensitivity of the company stock towards the market return. So we will be finding out the beta between company A and market return and company B and market return. So we should not get confused with these terms. So beta coefficient is nothing but the sensitivity of company's return with the market return, and correlation coefficient is nothing but the linear relationship of two stocks, and even it can be between the market return also, but here we are finding out the beta coefficient. So there are two methods of finding out beta coefficient, as we have previously discussed in the problems. So watch the previous videos for a detailed discussion on this. So as we know, there are two methods. One, if probabilities are given, and if probabilities are not given. If probabilities are given, then it is better way to use the covariance approach, covariance divided by the variance of market return. If probabilities are not given, then we can find out with the simple regression formula, as we have previously seen in the problem 8, using this formula. But even we can find out, even if the probabilities are not given, we can use the covariance approach. It will give us the same result. The logic is nothing but covariance accounts for the weighted proportions also, but simple regression formula will not account for it. Going further, ICAI is followed with covariance approach, covariance divided by the variance formula. We can use it with the simple regression. It will give us the same result. Now beta coefficient of the shares of company A. So company A separately and then company B separately we have to find out. We have the returns for 3 years and then market return also. Now the expected return is nothing but the average. So for company A, expected return is 11.43. Market returns expected return is 14.67. This is nothing but the weighted average. So for company return A, it is 34.3 divided by 3, 11.43, and 32 divided by 3, 10.67. So the covariance of company A with market return, in case if probabilities are not given, then this will be the formula. So we have to divide it with the divided by the number of years or the items or the possibilities. If probabilities are given, then it will be sigma RM minus expected return of market multiplied by the return of A minus the expected return multiplied with the probability. So this will be the formula used if probabilities are given. If not, then this. Then same case with the variance also. RM minus RM expected return of market divided by this whole square summation divided by n. So which will give us the beta of 1.03. This is for A. Then going further for B also same thing. So average return of B will be 31 by 3, 10.33, then 32 by 3, 10.67, and applying in the covariance formula, and we are getting a beta of 0.5. Thank you.